If there's one thing most people agree on, it's that banks are some of the most powerful, greedy, but lucrative corporations of all time. So you have two choices. You can either be mad because the bank charges you interest on your mortgage, credit cards, or other debt, not to mention bank account fees, or two, you can buy the bank and join the party so you too can start earning interest instead of paying it. So love them or hate them, if you live in Canada, there's a really strong chance you're a customer of one of Canada's big six banks. So in this video, I want to discuss three ways you can easily invest in the big six Canadian banks, which are by far the most popular and enduring dividend-paying corporations in Canada. If you research dividend stocks in Canada, it's almost impossible that one of the banks does not appear in your results. So I'm making this video now because it's the best opportunity in over 10 years since the 2008 recession to invest in the banks, as they are trading at huge discounts due to the COVID-19 impact on the economy. In fact, they have already recovered substantially since the March crash, but the window definitely isn't closed for you to get a great deal, as they're still heavily discounted. So banks don't perform as well when interest rates go lower, because interest is how they make most of their money. Therefore, when the economy is in bad shape, it's a good time to invest in the banks. So you see them everywhere you go. The undisputed king, Royal Bank of Canada, or RBC. Second biggest is TD Bank. Coming in third is Scotiabank. Fourth is the oldest bank in Canada, Bank of Montreal, or BMO, which has been around for over 200 years now. Fifth is CIBC, and last but not least, National Bank of Canada. So on average, between the six banks, they have been around for about 155 years. So I don't want to spend too much time trying to convince you that investing in these banks is a good idea. If you actually need convincing at this point, you probably don't know how the world works. These banks are very, very well run and well regulated. In addition, just because they're Canadian banks, it doesn't mean that they only do business within Canada. They continue to expand in the US and abroad. They have been providing increasing dividends to shareholders for decades and will probably continue to do so in the future. So the higher the population and the more immigrants come to Canada, the more money they make on all the loans, all the debt people take on for their houses, their cars, their credit cards, student loans, small business loans, etc., etc. It's really not a rocket science. So, how can an average person like me and you buy a piece of the six banks? Well, it's pretty simple. Since they're public corporations, you need to buy the shares of the banks, which is essentially giving you part ownership. So which stocks do you buy? Do you buy all six banks evenly? Do you just get Royal Bank of Canada because it's the biggest one right now? There are countless YouTube videos and articles about this question, with everyone having different thoughts and opinions. Let's go through the three ways first, and then I'll share with you my strategy. Method number one is to buy shares of some or all of the six banks, so buying the shares individually. What are the advantages of this method? Well, first of all, you own the individual stocks yourself, so there are no fees to pay. If you would own an ETF, for example, that has the six banks, you would pay an annual management fee like every other ETF or mutual fund. Another advantage is that you're guaranteed to participate in the growth of the dividend. What exactly do I mean by that? Well, if you would own an ETF, there's no guarantee that the ETF manager will increase the dividend the ETF gives you. It might take a few increases from more than one bank for that to happen. If you own the stocks directly, you don't have that problem. If they raise a dividend, you get the raise then and there, end of story. So let's quickly check out the six banks one by one and check out what kind of annual dividend they're providing shareholders right now. So if you look at each of the six banks one by one for their dividend yield, I saved them all in my watch list here, one after another. So Royal Bank Canada is giving 4.70%. TD is at 5.24 here. Bank of Nova Scotia 6.58. BMO 5.89. CIBC 6.39, and National Bank of Canada is 4.68. So the average, which I already calculated for you guys, is 5.58%. So that would be your annual dividend yield if you would buy an equal part of each bank individually, which is really, really good. Also, don't forget that each individual bank keeps increasing their annual dividend. If we look at Royal Bank of Canada, just for an example, and look at the dividends in the last 5 years, and sort it, you could see that in 2015 it was $3.08, and they constantly increase the dividend. Right now it's at $4.32. So in 5 years it went from 308 to 432. Pretty good. And this it is just Royal Bank of Canada, but the other 5 banks pretty much have the same trend of increasing the dividends over time. So this is why they're really good investments, really good stocks to own individually. Method number 2 is buying ETFs that have the 6 banks. So the advantage of this method is simplicity and safety. You don't need to worry about which banks to buy or which banks not to buy because you get exposure to all 6 automatically by investing in one stock or one ETF. The ETF manager decides how much of each bank to get. Also, it lowers your risk in case one bank does poorly. Another advantage is that you can generate more dividend income than owning the banks individually, as ETF managers can use different strategies to boost the dividend income. Using a covered call strategy, which I've been talking a lot about in my most recent videos, is a very common method. So let's check out my 2 favorite covered call ETFs that invest in the big 6 Canadian banks, so you could see for yourself what kind of dividend yield they're giving right now. So the first covered call ETF that invests in the 6 banks I want to look at is called the BMO Covered Call Canadian Banks ETF. The stock symbol is ZWB. So if we look at the annualized dividend yield or distribution yield, it's giving 6.82%. So owning this one stock would give you more income than owning an even part of the 6 banks individually, so because it's higher than the 5.58% currently being given. So if we look at the holdings, no surprise, you'll have a pretty much an equal part of the big 6 Canadian banks. So this ETF invests in the 6 banks, but they give more income, or they're able to give more income because of the covered call strategy that they use. Same thing goes for the second covered call ETF that I want to look at covering the 6 banks. It's called the CI First Asset Can Bank Income Class ETF. So the stock symbol is CIC. Pretty much the same concept here. If you look at the holdings, it's pretty much an equal part of the 6 banks, but they're able to give a much higher yield because of those covered calls. The only difference with this ETF and the first one is that this ETF gives the distribution quarterly, so every 3 months, where ZWB is giving the distribution monthly or every month. However, you are getting a bonus because you're waiting every 3 months to get it. The dividend yield right now, the average dividend yield, sorry, for the last 12 months is 9.60, so much higher than the 5.58% that you would get by owning the individual bank stocks. The third and final method, and this is the one, by the way, where you could currently get a 15% dividend yield. It's investing in a split share fund that invests in the 6 banks. So what the heck is a split share fund? Well, I won't go into details too much on this right now, as I'm planning on making a detailed video covering split share funds, aka split corporations, in the future. But basically, it's like a covered call ETF on steroids. Essentially, a split share fund is an investment corporation with its own stock symbol listed on the TSX, just like an ETF, that typically holds dividend paying stocks, and they use different strategies like covered calls and leverage to boost the dividend yield you get on top of the dividends the banks are already providing you. So it's called the split because there are 2 classes of shares: preferred shares and Class A shares, or regular shares. So the preferred shares are not really interesting or worth looking at, in my opinion, because they give a fixed dividend payment every quarter, which is how preferred shares work in general. It's the regular shares, also called the Class A shares, that are worth looking at. So the Class A shares are funded by any leftover dividend income, once the preferred shareholders, of course, are paid, as well as all the income from the covered calls, the capital gains, the capital appreciation, all of which are enhanced by leverage. So leverage is the key point here that differentiates a covered call ETF from a split share fund. It's essentially leverage, that is essentially cheap borrowed money the fund manager uses to enhance the income they provide to us, the shareholders. So this results in astronomical dividend yields, but there is a catch. let's check out my favorite split share fund when it comes to the big six banks, so you could put all this information I'm telling you all together and you could see for yourself how it works. So my favorite split share fund that invests in the big six Canadian banks is called the Brompton Split Bank Corporation. The stock symbol is SBC for the Class A shares, and the stock symbol for the preferred shares, which we're not really interested in, is SBC.PR.A. So if we just scroll down and look at the portfolio, it's basically the big six Canadian banks. That's what you're getting, just like the covered call ETF. So you're getting good exposure to the six banks with only one stock. And the key to split share funds, like I said before, is the leverage, and you see that here: potential for capital appreciation for Class A shares due to leveraged exposure to the common shares of the big six Canadian banks. So that's how they're able to give you such a really high distribution yield, which is a little over 15% right now, which is absolutely crazy. And basically the catch that I was talking about earlier has to do with the unit NAV, or the net asset value. So for them to actually give you the dividend on the Class A shares on SBC, the unit NAV has to be a minimum of $15. If for some reason the banks crash and it goes under $15, you will not get the dividend. But let's check out the history real quick, because this stock or this fund has been active since 2006. Let's see how many times they've actually missed the dividend and how many times they've paid the dividends, just so we could compare. The annual dividend, by the way, on the preferred shares is currently 5.02%, just in case you were curious, which in my opinion is not worth it, because if you would buy the bank stocks individually, you would get more. You would get 5.58%. So if we look at SBC right now, the annual dividend, by the way, is always set at $1.20. So right now, 15.19 with the latest little drop today at $7.90. So when in doubt, whenever I see a crazy dividend yield, I always look at the history. That will tell you of what's going on. So if we look at the charts, we'll open up the maximum amount since 2006, and as you could see here, every little D is a dividend payment that they gave. So since 2006, have they missed any dividend payments whatsoever to their shareholders? The answer is yes. They only missed 4 months, 4 dividend payments in about 14 years now, which is absolutely nothing. So as you could see here, the 4 missed dividend payments was actually during the 4 worst months of the 2008-2009 recession. You could see that here. So you have the dividend September, October, November 2008, and then the next dividend is April 2009. So those are the 4 months where you miss. You basically missed December, January, February, and March, just before they re-enabled it on April 2009. Since then, they have missed 0 dividends, including right now, as you could see, if we just scroll, during the COVID-19, the bank stocks have gone down significantly. You could clearly see that if we just put the graph to a year, you could see the sharp decline. But hey, they have not missed a dividend yet. And like I said here, the unit NAV is well over $15 right now. It's at $17.51. So when you're skeptical about stocks that give you high dividend yields, always look at the distribution, the history of the distribution. This one only missed 4 months out of in 14 years, which is basically nothing. So in my opinion, this is a really good safe stock to invest in. So that's it, guys. Those are the 3 ways you can invest in the big 6 Canadian banks. Personally, I use a combination of all 3, but since I'm a pure income investor, where my priority is getting as much income as I can, I definitely invest a bigger percentage in the split share fund as well as the covered call ETFs. There is no right or wrong here. The important thing is to choose the method or combination of methods that you feel more comfortable with and start investing. If you want to understand more what a covered call ETF is, I made another video covering that, so make sure you check it out. And in the future, I'll also make a video covering split share corporations in detail, so stay tuned for that as well. If you have any questions, guys, for any of the stocks or strategies I discussed, don't hesitate, just let me know. I'll be more than happy to answer you. I've been getting more and more questions lately, especially about the covered call ETFs, which is great, as these are great tools to make you really easy passive income. So thanks for watching, guys. I really appreciate it. Take care and see you next time.